Hey everyone, good morning. And while we are going live, I am going to start admitting everybody into the ARMR Education Forum. Good morning. Welcome. I am your host, Michelle Rosenthal, and really the co-host. I'm just the second banana. I'm just the
Never.
real man that we're all waiting to hear from. So good morning and thank you so much for joining us. For those of you who are live on Zoom with us, I am so excited for you to be here. We really want this to be interactive and a way for you to have your voice be heard, to really talk to Bret one-to-one, asking your questions, getting perspective. So we're going to do that in two ways. I'll get to that in a minute. And for those of you on YouTube, welcome to the ARMR Education Forum. This is a different format than you're used to. Our week in review is now the second and fourth weekends of the month. And on the third weekend, we're doing something a little differently. So if you're on YouTube, go ahead and feel free to put your questions into the chat. I will be taking a look, making sure that we get to everything. Bret will too. And for those of you live on Zoom, I'm so excited for you to be able to ask your questions in two ways. Number one, you can raise your hand and speak to Bret directly. Number two, you can put your questions into the chat and I can feed them to Bret. So as we go along, if he's really off and riffing on something and you have a question to ask, feel free to put it into the chat as a bookmark. As we move through today, this is the very first ARMR Education Forum. Our goal here is to, number one, have our weekly week in review segment, which I know you all are waiting for. What went on in this past week? How is Bret planning to trade in the week ahead? And then this time is really for all of us to be able to say, okay, now how do we, oh my goodness, I don't know if any of you have a Samsung. Bixby wakes up when I'm not talking to her, so excuse me.
That freaks me out. I mean, someone's listening.
I know, it's seriously, but I just don't understand. And I've turned off all of the volume, so she's still picking up. Yeah. So the other part of what we're doing today after the week in review is for us to be able to really talk about the ARMR Investing Way. There are 3 stages. There are 9 steps. How can you be using them to really become the portfolio manager that you want to be, to go from whatever level you're at to that highest level that makes you able to trade and increase your net worth in all the ways that you really want to. So
I'm still using that list, trying to get to that point.
It's a work in
progress.
It's
a never-ending process.
Right? For everyone,
Yeah.
Because we can all, I don't know, I'm always every day striving to reach the next best level of myself. So in all kinds of ways, including not trading, but for me, it's understanding how you all are trading. And for Bret and all of you, it's okay, I've mastered this. How do I go to the next level? So we'll be talking about how to do that in the ARMR Investing Way and the way that it approaches that a little later in today's broadcast. So to kick it off, I hand over to you, the captain,
in all
ways, Bret Rosenthal, and the founder, for those of you who are new here, the founder of the ARMR Report. Bret, take it away.
Thank you for that very kind introduction. Let me remind everybody, I started the ARMR Report to really help me order my own thinking so I could execute in a more effective way. And so it's a never-ending process. I appreciate you all joining. Erez, how you doing? Andrew, what's going on, guys? Nice to see you. Andrew, our lead indicator on the economy. Nice to see you, Andrew. I'll explain that later. That's like an inside joke for ARMR insiders. Anyway, so step one, let's just dive into a review of the market last week, how I changed my portfolio, and then what I think I'll be doing next week. And then we can get into some of these questions specifically to how I view the ARMR Investing Way and how I try to execute it and what I hope it can add for your own process. So as always, I like to say we're running a virtual hedge fund. We're all portfolio managers of our own tranche of assets, and we each have to figure out our own risk tolerance, goals, and all those types of things. So what I'm sharing with you is how I run my own personal capital. And so it's your job to take the information and make it your own, right? So some of it may not apply to how you want to run your capital. Other things I say may apply. And so please make those decisions on your own. All right. Having said that, I'm going to start, I was starting to write the captain's log this morning, which I don't normally do on a Saturday, but I just discovered that there are so many conflicting pieces of information right now. And so I ended the week, for those of you who don't know, I ended the week 100% cash. I didn't carry shorts overnight. Obviously, the risk monitor went red on Tuesday. And so made my way to cash on the long side of the portfolio. That's a no-brainer. And then, had a short position on the indexes and decided to close that out and take the weekend to think about what the next steps are. So let's just take a look at a couple of charts and I'll walk you through my, my thought process. All right. So you should be seeing a chart of the S&P right now with all the different lines I've got on it. It's getting a little confusing, but all these lines are important to me and they make sense to me. So let me share with you what I'm trying to do here. Obviously, head and shoulders
Bret,
top.
Just a second. Am I the only one that's hearing feedback? You might want to turn down your, do you have your speakers on?
With all the different. How's that? That better? I can mute it. Hello? Ken's pets, anybody there? I don't hear you now, Shell.
Okay, I'm here. I'm here.
Oh, okay, there it is. So
everything seems to have resolved itself. Might have just been a Zoom glitch.
Oh, maybe, but I did. I took my speakers down a bunch, so maybe that helps. All right. So just looking at the chart here, what we've got are the three yellow lines over here, which is, the low of each Fed action. And so next week we get the FOMC meeting again. And this is partially why I decided to be 100% cash going into the week. I really want to be able to clear my mind and then execute based on what I'm seeing, right? Read and react to direction. I could argue with you that the market is going to go to new lows on the year. That's what I think. Okay. But in order for me to stay short overnight, let's just talk about shorting for a minute. Shorting is very difficult. It gets most people on the wrong side of the trade. Let's be honest, the market goes up most of the time. So you're fighting a negative trade. Okay. What I mean by that is, statistically speaking, what does the market go up 80% of the time? And so at the ARMR Report, I like to say we want to get on the right side of probability when reward's worth risk. So it's not that I won't short, but the minute we start shorting, we're going against probability. I don't care what we think the market should do. Yeah, the market should go down. I got all the reasons why the market should plummet, right? But our job is to get on the right side of probability. Our job is to protect capital when the market's plummeting in any fashion we can. And I just wanted to give everybody a perspective. Just take a step back and look at your performance this year. I don't know what yours is. You could be plus or minus 5% on the year. I don't know. You could be down 10% on the year. Okay. The NASDAQ's down about 30%. So you've got huge alpha, even if you're losing some money this year. If you've done your best to keep it as tight as possible, that's step one of your job. You've got large alpha. So step two of our job is to capture that alpha. What I mean by that is, what we really want to do is find the long entry points into the S&P to capture the alpha when the market rallies. That's really step one. Now, if we can add to alpha by being short at the appropriate time and making some money, hey, I'm all for that for an aggressive portfolio. But the big picture is to protect capital in difficult markets like this, so that you can come out of it ahead of everybody else, ahead of the indexes, right? And get to new highs in net worth while the market's still down. Like, that's the process. So we want to capture that alpha. We have to recognize that in a very difficult market like this is, no matter how great the investment idea is, they're all getting taken out to the woodshed. That's what bears do. They eat everything. They eat everything. And it's not that you can't make some money on a quick swing trade. You got to be wicked fast in this market. But one idea after another, one great looking chart after another, blown apart, blown apart, blown apart. And that's a function of a bear market. So on the one hand, I say to you, the market's going a lot lower. And you might say, well, why am I not short overnight? I will be short overnight. But in order to do that correctly, I think you have to short rallies early in the day that roll over and collapse, and you have a nice fat cushion for your principal. That I'll carry overnight, right? So if I put on a trade, let's say the market gaps up to Monday morning and I get a short trade going and it craters into the close, I might carry that overnight. But when I've done the research and looked at all, the possibilities in the bear market, more money can be made, in my opinion, trading intraday, the indexes, than trying to carry shorts overnight. So I tend not to do it too much, but every now and then I will. Like right up here, we captured, that top in the market. We made some money on that sell-off here. Put some capital to work, not last week, the week before, and then the market imploded on Tuesday, right? So right in here, we had a risk monitor yellow, popped up, reversed, and collapsed. So you all are aware of what, ARMR insiders, you've been part of this, so you know what's going on. And what I said to you last week was, all right, risk monitor's back to red. We're going to try to hold on to a couple of positions that haven't hit stops yet. And we'll see if we take out the lows of last week. If we close below the lows of last week, which is now, 2 weeks ago, I would expect the market to go down and test the lows of the year and perhaps make new lows. When I say bears eat everything, let's just take a quick look at some of our favorite charts, right? And I really like Southwestern Energy. Perfect double top with a collapse back below the 50-day moving average. We really like Range Resources. You can't argue with that breakdown, but it just looks terrible. We look at natural gas. That's like a perfect top in natural gas with the total breakdown. We look at USO. What does this mean to you? I'm trying to figure this out. That's why I was writing Saturday suppositions. There's so many cross currents. It's hard to understand. On the one hand, tons of inflation, supposedly. On the other hand, we're seeing collapses in commodity prices. This is why cash is king right now. ARMR growth portfolios are in cash. ARMR ETF portfolios are in cash. The only thing I'm holding right now is my dividend portfolio. And that's because I manage assets in different tranches, right? So that dividend portfolio I structure, I collect yield. It's basically pipelines, okay? And I understand my principal will fluctuate. I'm going to collect that yield and I'll try to protect it with other actions on other parts of my portfolio. So on the one hand, you've got this discussion about inflation, which I understand. People are paying more for things. I get it. CPI and all that kind of stuff. But on the other hand, we're seeing breakdowns in commodity prices. And to a certain extent, the inflation that we see is based on supply chain issues and war in Eastern Europe and these types of things, which it's very difficult to figure out when that's going to end. I mean, you say I'm crazy, it's never going to end. Okay, I don't know. Maybe it won't. There could be an armistice next week. I mean, we don't know is my point. What would happen to asset prices if, for instance, energy, just for the sake of game theory right now, let's just spitball for a minute. Natural gas and oil didn't have a very good week last week. What's going on? Well, seems like Ukraine is pushing back on Russia. What if we get to a stalemate? There's some type of an agreement, even though we don't think that's going to happen. But I'm just spitballing with you. Let's just say that happens. What do you think happens to energy prices in an environment like that? Any type of cessation in hostilities, even just a break for a while. I mean, asset prices in energy, natural gas would crater. So we then look at the stocks and it's like a rolling bear market. So one group that leads ends up succumbing to the bear. So on the one hand, I want to be short. On the other hand, I want to show you this chart. That's an incredibly strong day for high yield bonds on Friday. Now, you could say that the rally up in equities on Friday had to do with options expiration, but there's not. Options expiration doesn't affect high yield bonds. And yet junk bonds had a great reversal on Friday on higher volume, and bonds usually lead equity. So that would be bullish. So you can see why I'm writing Saturday suppositions, right? I'm trying to write it all down and look at it and say, what is going on with the market? And I'm very content being in cash right now. When the risk monitor goes green, I'm going to put capital back to work. I may short next week depending on how things behave, but I'm only going to short strength. The market craters early in the week. My expectation is that the market would rip higher after the Fed meeting, which it's tended to do. If it sells off into the meeting, the news comes out, we all know what it is. Market reverses and rallies on the news, right? And we're going to do that on the ARMR desk, right? You guys are going to be with me trading. It's a classic ARMR day trading playbook setup. We love it. Every time the Fed speaks, there's the reaction at 2:00. We don't do anything for half an hour. We wait for Chairman Powell to start speaking, and whichever direction it goes after 2:30, we hop on for a rip. Usually it's higher into the close. Every now and then it's a collapse, but usually it's higher. The reason for that being, once the news is out and everyone knows how bad it is, blah, 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 nobody needs to hold volatility anymore. So VIX gets sold, puts are being sold, market rallies to the close. It's just like one of our favorite trades. So on the one hand, I keep being told inflation is going through the roof. On the other hand, and we talked about this last weekend, I know it's fun to kind of laugh at Kathy Wood because she's kind of, I don't know how to describe her, but I think she has good long-term picture views. She just doesn't manage risk very well, right? So she just buries people in her ideas. But long-term, I think innovation is a great place to go, and I can't wait to put capital there. And we can go over some stocks that are at the top of my list for that. She's calling for deflation. She's calling for deflation. Shows Jeffrey Gundlach, who's one of my favorite bond guys. I think he's one of the smartest guys in the bond market. He's calling for the same thing. So we're at a strange crossroads, and I think protecting capital, holding cash, reading and reacting to what we see in the market, and quite frankly, for me and the ARMR Investing Way, I'm going to really be executing using the risk monitor. It goes green. I want to have a nice spread of indexes, and I'm going to leave this part of the conversation, and we can go on to a different discussion. But for today, I just want to share with you that my focus going forward, what I think is very important when the market's down 25, 30% for the year, whatever it is, when we get that monitor green signal, the simplest and easiest and quickest and most important way to put capital to work, in my opinion, are the indexes. I want that exposure on cheap. Make money on the index trade, earn the right to take more risk and start filling out the portfolio in individual stocks. It's easier to manage the risk in indexes. Not as many stocks to trade, not as much slippage as you're trading. Easier to hedge. So in other words, we get risk monitor green next week. Who knows? It's possible. Look what happened to high yield bonds. They could be leading. Fed comes out, raises 100 basis points and says, we're done for the year. Market will go up on that news. Risk monitor turns green. I will own the S&P in a big way for a lot of my capital. I can hedge that simply by being short intraday Qs and small caps. We've done it on the desk. We start making money there. We spread out the portfolio into a handful, quite frankly, I think, of innovative names. Those charts look the best to me. And I'll just share a couple of names as an example. But you see carnage out there. And then I look at like Pinterest. Pinterest is just in a nice, steady, quiet consolidation near a low. This is a turnaround story. This is one of my favorite stories, new chief executive and all that kind of stuff. Stock's in an uptrend. And we booked a profit in snow last week. I would have loved to have held it. but it obviously made a double top there, the 200-day moving average. So we took the capital out. Right. But look at these trades. They're all doing the same thing. So to me, the portfolio I want to structure, if we go risk monitor green, index first, fill it out with some of my favorite innovative names to create some extra alpha, and then hedge. That's what I'll be doing next week if we were to go green. If the market just craters next week, I'll be opportunistically looking to short. And if I catch a big move down, I might carry that overnight. I may. All right. So that's the week in review and what I think I'll be doing next week.
Okay, Bret, hang on just a minute before we move on from this segment. I just want to, Erez put some interesting thoughts into the chat, and ID Doc made a comment that I think it's going to be interesting to share over on YouTube. So let's start with Erez. Erez wrote, after a hard sell and OPEX, usually there is a bounce, and it will be reasonable to short the bounce, in his opinion. What are your thoughts on that?
Yeah, that's what I'm saying, Erez. That's why I went to cash at the end of the day Friday and didn't carry shorts overnight, because I totally agree with you. If we're going to carry shorts overnight, you need to get the pop, short that, capture a good day trade, and turn that into an overnight hold. So I couldn't agree more. Let me crack Foxy for a minute, Michelle, before. Okay, go ahead. Give me another question before I do. I want to share a couple extra charts because it's interesting. Go ahead.
Okay, and I think it will be well placed after this question or this comment from ID Doc on YouTube, who wrote, "It looks like reverse head and shoulders to me." I think he was talking about ID Doc. You know what? You could drop in the chart that you made this comment on, if you remember. But he wrote, "It looks like reverse head and shoulders to me. My crystal ball tells me that the market will go sideline before FMOC, then will rally with a 75-point increase in rate. And a bear market is a 0.75 point increase." Right. Yeah. And then he wrote, "Bear market is a trading market. I know it's beating a dead horse, but do you think it's time to buy gold miners? I see double bottoms in GDX and GDXJ." So it's kind of two-part comment there.
Mo, I thought you'd never say that, brother. I thought you swore off on precious metals, Mo. I love it. Because you know what? We all have to be fluid in our thinking, right? And so, you don't force your will on the market. You never write something off, and you keep your mind open and you read and react. So let's look at the precious metals chart for a second, right? The lead one has got to be silver. Okay. So silver had a great close on Friday. That is an impressive close on silver. You got the double bottom. This is PSLV we're looking at, by the way. Okay. My favorite way to play silver physical, Sprott physical silver. Okay. So there's your double bottom. And if we just, zoom out a little bit. So totally unwound everything going back to the breakout originally in 2020, put in a double bottom, gapped up, closed the gap, and had a really strong close to the end of the week, which is an inside out reversal day, closing back above the 50. I almost bought that, Mo. I almost put money to work at the end of the day on Friday on Sprott physical silver, but I wanted to really go into the weekend with a clear mind, no positions, figure out what my next steps were. I don't think anything's going to run away from me. Who knows? I mean, I guess they could squeeze silver and gap it up, but then I go look at GDX. Okay. There's no signs of life in GDX to me. These are lower lows, lower highs. I don't see anything that looks interesting to me. I mean, you want to say that's a tiny double bottom. That's just not big enough of a double bottom to get me interested. So I don't see anything there. If I was to go anywhere, I would look at silver stocks first. SILJ, the silver juniors, have a double bottom here, but they did not confirm what we saw in physical silver. So the jury's still out there. If SILJ can close back above that black line, which is the 50-day moving average, I might have an interest there, and I might be adding SILV PSLV at the same time. PSLV. So, but here's my problem. I'm really warming up to the fact that we could be heading into a deflationary environment. I'm really warming up to that. In fact, I'd submit to you that we would already be in a deflationary environment if we didn't have war in the Ukraine and, constant lockdowns and all these types of things that have disrupted the supply chain. So at some point, those things resolve themselves and we get left with a normal market and we look at what's going on. And I don't think it's runaway inflation. But then again, gold goes up and it's a function really of the US dollar. So I don't know. I mean, the dollar, if the dollar comes down dramatically, metals prices are going up. So this is a view of the dollar, and the dollar's still in this massive uptrend, Mo. So for me, I mean, we can get lost, in the weeds talking about inflation and deflation and all this other kind of stuff. But all we really have to do is look at that chart right there. I don't know if that's where it is, but that's where it is on my screen. Look at that chart right there. That's the dollar. If the dollar stays in that uptrend and keeps charging higher, it's going to be very hard to see gold and silver go up a lot. I mean, it could. I know people can always tell me there's times in history where metal goes up with the dollar. Okay. I can't wait to live through one of those times. I just haven't seen it. Right. So if the market gets back up to this, green line, the market, if the dollar gets to the green line, the top of this channel, that's a negative for metals. If it can't get to the top of that channel and breaks down, then you say, okay, this uptrend, the dollar is starting to fade, starting to fail. And I get more interested in the precious metals. But let me crack Foxy for a minute. Okay. Let me crack Foxy for a minute. There's so much conversation of this market looks like that market from 1990 or 2008, or I've even seen, IBD did a whole thing, a whole webinar on this market looks like 1962. And I want to share with you a couple of charts because I find it interesting. I'm going to go over here and just share this with you. So this is what the market did in 1990. Sold off, rallied, pulled back, which is what's happening right now. So the argument from IBD is we're getting a market that looks very much like 1990, 1962, right? So it bottoms, rallies, comes down, and then skyrockets. So who knows? Next week, Fed raises whatever basis point, says they're on hold the rest of the year, whatever, and the market takes off risk monitor green. And this was 1962, right? So it made a double bottom, came all the way down here, which is almost what's happened now, right? Rallied off the low, pulled back, tried to rally, failed, holds the low, skyrockets, right? And just to scroll forward. So here's 1962's market, and here's 2002 year to date. I found this really interesting, right? I'm going to crack Foxy in a minute because the variation could be 1962. Look what it's doing. So it comes down, tests, and then takes off. And I share this with you just so we don't get carried away with the negative stories, right? There's always negative stories, and the market reverses and skyrockets for reasons we find out later. So here's the aftermath of 1991. Total, skyrocket off of the lows after it looked like the market was going to implode. Okay. And so they argue you had this top in 1991, this breakdown, rally up, pull back, right? Which is what's happened now. Rally up to the 200-day pullback, reverses and takes off. So if it reverses and takes off, you got another 91, 1962 type market. And then here's this. This is what I want to show you because it's just so much fun to me. Check this out. All right. So now let's look at the bearish picture. Oh, that's 2008. That's 2008. Looks like the market is following 2008, which means it's going to absolutely crater in here. So my point right now, and I'm going to stop sharing the screen. I'm going to look at you guys. Okay. I'm going to stop sharing the screen there. And I'm going to say, look, my point right now, as I crack Foxy for a minute, is that we have to read and react to the year that we're in. Don't get caught up in, could be 2008, could be 1991, could be 1962. It could be any year, but it is 2022. I can guarantee you that. It is 2022. All right. So we have to read and react to what we get. And so going into this is kind of why I was looking at this on Friday. I was like, I need to be cash right now. I could argue either direction. I need to see, I got to get past the FOMC meeting. I got to read and react to what I get. If we get a rally up that fails, like Eric said, that'll be our opportunity to get short. Maybe this is 2008. If we get a rally up that triggers risk monitor green, I'm going to be putting money to work. Okay. And by the way, guys, if you check the Slack room right now, I am working on a new algorithm, or should I say, an adaptation of an ARMR S&P algorithm. And I'm trying to fill the gap. The reason I'm working on this algo is that I want to fill the gap between risk monitor red and risk monitor green. I want to be able to put some trades on that can capture upside in a market like this. And so I've taken my basic algo, the S&P algo. You know, we have our risk monitor. It's 7 algorithms designed for all 7 indexes. And when we get Confluence, that gives us the highest probability of the beginning of a new bull market, for lack of a better way to say it. We didn't have Confluence 2 weeks ago, risk monitor yellow, and it failed immediately. So you really want the Confluence. That's what gives you the highest probability of a longer term successful investment window, so to speak. But in between those two things, there's a lot of tradable opportunities, particularly in the S&P. And so I'm adapting the S&P algo and optimizing it for that type of movement and it looks like right now, I have some pretty interesting numbers I dropped into the Slack room for you. We're somewhere around 83% accurate, 4% on the upside is the gain, 1.2% is the loss. And it's trading it takes about 9 days on average for these trades, and it trades about once a month, it looks like. So there's a lot more work I have to do, okay, to tighten the screws, optimize it and all that. But those are the first numbers that are dropping out. And so I think it'll be fun. It'll be a way to capture some of the rips off the lows. And so ARMR Insiders, I'll be sharing with you as I go the process of optimizing the algorithm until we get to a point where I think we can actually trade it. I'll share whatever information I develop. Anyway, Shell, those are my thoughts. What else you got for me, Michelle?
Okay, excellent. So I just want to take a quick break just to remind everyone who's on YouTube, if you did not see the announcements that have been made all week, if you would like to join us live on Zoom so you can speak with Bret directly, which is the segment we're going to move into in just a moment, all you have to do is go to armorreport.com and join the email list. That is the place where you will receive the invitation to register for this event. So if you have not yet become a part of the ARMR universe, just head over to armorreport.com. At the very top of the screen, you'll see where you can join the email list, and then going forward, you can be live on Zoom with us as well. Bret, before we shift over to that area of actually interfacing and chatting with everyone, I just want to clean up one outstanding question in our YouTube live chat, which is from Robert Musella. And the question is, Bret, I've been short TNA for a swing trade at about $40. I'll be covering Monday. Then going to go short the indexes after the Fed meeting if we get a rally. What are your thoughts?
Say that again now. So he's short triple small caps.
We short TNA.
Small cap bull 3 times. So you're short TNA. Okay, go ahead.
And then at about 40 that he'll be covering on Monday. And then looking to go short the indexes after the Fed meeting. So this sort of relates to your thoughts on how are you trading this upcoming week?
Geez, man, you got to read and react to it. I don't. Obviously, I can't tell you how to trade because you're trading a strategy different than my own. So I can just share with you what I'm doing. But at the end of the day, you know, the ARMR day trading playbook on Fed day is there's this particular play that we make that's highly accurate. And normally we're long on Fed day. Every now and then there'll be a short opportunity, but most of the time we're long. I can't predict it though. I got to see what the action is and then put the trade on. So I want to get away from predicting, Michelle. That's kind of what I'm trying to say in today's discussion. If you were to boil down the week in review into what we have to do going into next week, It's to clear our minds and stop predicting, because everybody out there is predicting, right? William O'Neill's telling us it's 1962, it's 1991, and that led to huge rallies, right? And then we have a clear chart that it looks exactly like 2008. The market's going to crash. I mean, there are so many moving parts. There is no confluence. This is why cash is king at the ARMR Report right now. And on top of cash, it's that we have to go in with an open mind and react to what we see. And so that's what I would say. I would caution against trying to predict what the next trade is. I don't know if that's helpful, but in the meantime, Michelle, before we hop on, I want to just, give a shout out to Andrew Coe, ARMR Insider, because he is like the greatest lead indicator on the economy that I've ever seen. Andrew works at FedEx, and he was all over FedEx early on in 2020, based on his comments inside the Slack room. It led, that really confirmed a huge rally in the whole market. And over the last couple of months, maybe, I think it is, Andrew, you've been talking about how difficult it is at FedEx. And oh my God, that was just the greatest lead indicator to a collapse in FedEx price. So the next time Andrew has anything to say about his job, I'm putting a trade on. That's all I have to say. All right, move on, Michelle, move on.
All right, so this is, at this point in our ARMR Education Forum, I've been looking forward to this, and I really want to hear from all of you on Zoom. Now's the time to raise your hand, ask a question, talk to Bret live. And for those of you on YouTube, drop your questions in the live chat. I'm there with you as well. I'm sort of doing double duty in both places. And as we move forward into this space, what we really thought would be fun was to chat about the ARMR Investing Way and how to apply it. There are a lot of people who can't be on the desk all day, or there's just not enough time while you're trading to ask every question you want to ask about how do I do this fundamental research in a way that I can really find the right stocks? Or how do I time my entries according to this algorithm? I don't really understand. How are we doing this? Or what's the best way to manage my risk and protect the gains on a trade? So for those of you who are live on Zoom, raise your hand, drop your questions in the chat. I'm happy to read them out if you don't want to be on camera. And for those of you on YouTube, if you have questions about how do I take the information of the ARMR Report and use it, because the algorithms that Bret has optimized over more than a decade's worth of just focusing on that, it's just incredible what he's able to do. And then as you put that together with a trading psychology and a mindset that has to be managed at the same time, because you can get all the information that you need from algorithms and fundamental research, and you know where to set your stop loss, and then you have to balance it with how your mind monkeys around with you. So any questions in any of these areas that you would like Bret to answer, now's the time. And while I'm going to let all of you think about that, some people sent in questions, Bret, because they weren't able to be here today. So I'll just start asking you some of the questions that I have on tap. So let me just pull up my list here. And I think really the best place to begin is to explain, the trading psychology. You were just talking about reading and reacting. It's so hard, and we see this on the desk every day. And so the question that I hear frequently in DMs during the trading day, and that I know people are asking you, and that somebody wrote in and asked me to ask today, is how do you keep your mind from, and really your emotions? The person wrote your mind, but I think it's really your emotions. How do you stop your emotions from interfering with your execution? So you want to speak to that a little bit?
Oh, geez. Yeah. I think that, and that's a constant struggle for all investors and all traders. Okay. Particularly if you have on any type of financial news network, right? So the first thing I do to control my emotions is that I don't watch CNBC. I don't watch Bloomberg. I don't watch any of that stuff. And it's so funny because for a number of years, I used to have part of my trading cockpit was a TV setup so I could see everything that was on CNBC as it was happening. Total waste of time. Everybody's got an axe to grind. They bring one guy on that argues one way, another guy argues the other way. It's a complete waste of time. It's a mind suck, and it gets you off of what the strategy is. So, rule number 6, the ARMR investing rules of the road, right? Number 6 is turn off TV, make your strategy when the market's closed. And then when the market opens, you just execute that strategy ruthlessly and avoid making all the other trades, right? This is something that's so hard for me. I don't know about you guys, but for me, this is why I do the morning meeting with ARMR insiders, right? The idea is to say, okay, here's the strategy we're going to execute today. Now the bell rings. Let's just execute that. I'm willing to accept whatever the results are at the end of the day if I executed that, because we thought it through. Market was closed. We looked at algos. We did all the work we could possibly do. We said, okay, this is our path today. And we didn't get pulled astray by what we heard on the news or whatever, or market craziness didn't change us. We just executed. If I get to the end of that day and let's just say I've lost money, I am content with that day. I know I'm not going to make money every day. Okay. And I say, okay, I executed my strategy. I have to maybe shift the strategy. Maybe I don't, right? The strategy is not a one-day strategy, right? So I'm working on executing. So in order to deal with emotion, figure out what your strategy is and then just execute it. And what I find is there'll be this moment where I'm about to hit the buy order. And I tell you guys on the live desk, as we're doing it together, I say, somebody stop me from putting this order in. This has got nothing to do with my strategy. It's an idea. It just came into my head because I read something on Twitter or whatever. And that's not a way to invest. If the idea is good, it'll be good tomorrow. Give it 24 hours. Think about it. Let the market close. Do the research you have to do. If you want to add it to your strategy, add it. If not, discard it and execute ruthlessly. So I don't know, Michelle, if that answers the question, but that's what I try to do. And it's like a constant battle for me. I mean, it's hard not to get pulled off in a different direction. So coming into Monday morning, I'm 100% cash. I'm looking for opportunities. I want to get long the S&P and short the Qs and the small cap. That's my strategy because that's my day trading strategy. So whatever I see, I'm going to execute, and I'm not doing anything else unless the risk monitor changes, right? So no matter what's going on around me, this stock's going up. This stock looks good. Maybe gold's going up. I don't care. If that's not my strategy, I'm not touching those things. This is what I'm going to execute. That's it until the risk monitor changes. That's it. Now we'll see if I can do it.
I think that's a great answer, Bret. And I love that question. And I love this whole topic because I think it's so easy to think that somebody else is better at this part of it than somebody else. And really, it's just a human struggle to conquer your mind. And that is partly why in the ARMR Investing Way, as part of ARMR 2.0, especially, we're really building out the trading psychology portion of what you do and how you do it so that can be more and more a part of how we approach every single day so that everyone gains more control over your mind. And I mean, the value of that trading on and off the desk is so huge. So Nick Holden is part of our Zoom meeting, and he has a question. Nick, would you like to unmute yourself and ask that to Bret in the context of the ARMR Investing Way? Because if you would, you can go ahead. I think you just unmuted yourself. Go ahead, Nick.
Yeah, just want to ask a question. Is there any indicators of which you constantly looking on, which might convince you that okay, so here is we already passed the bottom and we are in a reversal. If any, is it possible to monitor something?
Okay, all right. Thanks for the question, Nick. And when you say indicators, are you talking about technical indicators like stochastic or MACD, or are you talking about bigger picture indicators?
Bigger pictures.
Oh, okay. Well, following the ARMR Investing Way, let's start there and then move, and then we'll broaden out. The ARMR Investing Way, the simple answer to that question is the ARMR risk monitor. Like that's the whole purpose of why I created the risk monitor. So we're looking at 7 index algorithms. So took the algorithm and applied it to the 7 indexes, the S&P, the Dow, small cap, the NASDAQ, those 4 are the majors, IBD 50, which is our innovative index, momentum, and value. And that covers the entire market for us. We did a lot of research looking at a whole bunch of different, markets that we wanted to try to use, but those 7 really do it for us. And when we get all 7 indexes with ARMR algos geared for each, when I say geared for each, I mean the basic engine inside the algo is the same. And then we just look at the volatility components. And so they're all a little bit different. So they have to be calibrated for the volatility of each index. When they all tell us the same thing, when they all go positive, risk on within a 48-hour window, okay, that's our Confluence move. And that will go positive well before the news cycle tells us the market's going up or tells us that, in fact, the news cycle is usually still incredibly negative when that goes positive. Okay. And the most recent and glaring example is March of 2020, right? Risk monitor went green and I'm still washing groceries for an hour. Okay. So what's going on? We don't know. World is in a pandemic. Monitor goes green. The Fed starts adding liquidity and we know it was a massive bull market. So I don't know what the news stories will be, what the indicator will be that changes the fundamentals. But I do know that when we get risk monitor green, I'm putting money to work. Now, that's not a guarantee the market goes up. We see greens. If you look at 2008, we had a series, I think there were 4 green signals. They all lost money because we were in the midst of a financial crisis. Okay. So how do we deal with that? Position size is key, Nick, to help put capital to work for me, because there's no single shot indicator. For every one indicator I could show you that looks bullish, I can show you one that's bearish. And that's usually what it's like, at the turn. I mean, it's always very confusing. So I just go with my risk monitor. It goes green, I put capital to work. As a portfolio manager, how to use the ARMR information. When you get that green signal, each manager determines how much risk they want to take. So I find this is very important because there's never going to be a silver bullet, Nick, that gives you an indication market's definitely going up. We don't know. So all we can do is get on the right side of probabilities when the reward's worth the risk, and then execute to the completion of that signal. Okay. If this is a very difficult, I'll give you an example where the fundamentals match up with the technicals. If the risk monitor goes green and the Fed says, we've made a huge mistake, we're done raising rates, and we're going to start quantitatively easing. That would be the easiest dinner bell that's ever rung in the history of ringing, right? We're going to put all the capital to work we can as fast as possible. That's actually what happened in 2020. It looked bleak. The world was ending, but the Fed was liquefying everything, and the risk monitor went green. So we got aggressive, put a lot of money to work, had a huge year. It may not be this way this time. It might be more subtle. It might be the Fed says, we're raising 100 basis points, but we're going to take a break for the next 6 months to see what the data tells us. And there'll be talking heads on TV that argue both sides of what that means. But we get risk monitor green. The market could have a huge rally off of that, even though the Fed's not necessarily adding liquidity. So we recognize these are statistical probability algorithms. These aren't neural networks. It doesn't take an MIT education for me to create these algos. It's thousands of lines of code of probability metrics. Okay. We recognize we're going to be right, hopefully let's say 70% of the time. That means 3 times we're going to have some losses, but we're going to hop on the right entry point. Net worth will go to new highs when we do. That's how this works. So instead of it's a long-winded answer to your question, but instead of getting caught up in what's the one indication that's going to tell me the market's turning, I just have a strategy. I execute that strategy. I recognize my stops, and then I go and start over. And if I'm uncomfortable with the market, I'll still put money to work on a risk monitor green, but I'm going to focus on indexes first. That's the key. And that's what gets you past the inertia. You get the risk monitor green, it's like a deer in the headlights. What do I do now? I mean, the market looks terrible. How can I put money to work? Hey, man, if you're hovering around break even, let's say for the year, and the market's down 30%, you get a risk monitor green, how difficult is it to put some money into the S&P? I mean, you're just capturing alpha. You could take a small loss on that trade. Market plummets. Now it's down 50%. Okay. Now you're down 5% for the year. Market's down 50. You're still killing it. Your net worth is close to break even, and you'll take the next cycle. You see what I'm saying? And it takes away this impossible task of figuring out what the next news cycle is going to be. And it just focuses on executing reward to risk probabilities. I don't know. It's a long-winded answer to your question. What's up next, Michelle?
It was a good answer. Hey, Wesley, welcome. Good to see you here. Wesley has a question. Wesley, would you like to unmute yourself and ask that directly to Bret? If you're in the bottom of your screen with your cursor, you can just click the speaker button, that mic. If not, I'm happy to ask. Just wanted to give you the opportunity to speak directly with Bret. And Bret, while Wesley's deciding, I will go ahead and do you see the question?
Yeah.
The question is, I don't want to miss the train on a big up day. If my trade seems to be working, when is the time to add rather than take profits off? Alternatively, if my trade
let's stop right there. Let's just do one thing at a time. Okay. You don't want to miss the train on a big up day. If my trade seems to be working, when is the time to add? See, right there, the ARMR Investing Way does not pyramid up. If we have an entry point, we put all of our capital to work on that entry point, whatever that capital is. So let's pretend you like to put 10% of your capital into each position. You have 10 stocks in the portfolio. When you get your entry criteria, whatever it is that you're using, the full 10% goes to work. I think pyramiding up is a terrible plan. And I know a lot of people like to talk about it and they say it works great. And I submit to you, it only works great in a ripping bull market. The rest of the time, it ruins a nice entry point. So step one is, for me and the ARMR Investing Way, I get an entry point, I put my capital to work. Whatever the maximum capital is what I put to work. Now, here's the rub. Here's the hard part. When you put the capital to work right there, you think this is my maximum. That's it. I'm going to put the money to work. Then it starts going up, and greed starts to eat away at your mind. Oh, this trade's going to go even more. Oh, I don't have enough. Oh, I got to buy more. Let me tell you something, brother. You got to fight that beast with everything inside of you. Walk away. Don't be greedy. Be happy with the position you got. Manage it to success. So that's the first thing I would say. And it's different than what most people will tell you. Okay. So go ahead, Shell. And let me tell you one last thing. So finish that trade to completion. And if you say to yourself, I didn't have enough. Okay. The next time you put money to work, put some more money to work because your strategy is working, but don't mess up that trade. I like to say you have to earn the right to take more risk. So make your money on that trade. Look back, say, that was a great trade. I made money. I've earned the right to take more risk on my next trade. Go ahead. What's the next part question?
Okay. The second part is, alternatively, if my trade worked and I kept my position overnight, I don't want to get crushed the next day. Do I just raise my stop the next day? I love this. It's a risk management question. One of my favorites.
Oh, yeah. I feel like that emoji. Because there's, I don't want to get crushed the next day. I've kept my position overnight. I don't want to get crushed the next day. Well, first of all, if you keep your position overnight, I don't know what position you're talking about, but anything can gap down. So you better be prepared for that. How do you deal with that? One thing I like to do in my strategies is when I put a trade on and it pops, I do this on a day trading level, and I would do it on a swing trading level. Okay. I'm assuming we're talking about day or swing trading. because investing is totally different. We'll put that over here. When I'm investing, I don't take anything off the table. I'm buying something what I think is right, and I let it go, and I see if I'm going to make a lot of money over a long period of time. And I move my stops up slowly because it's an investment and I'm in a bull market and all that kind of stuff. But I assume we're talking about day trading and swing trading. So if I put a position on and it pops and I catch it right, and I want to hold it overnight, one thing I would do to deal with the emotions you're talking about is book a certain portion of the gain and raise the stop to break even. And then let's see how far it can go. Worst case scenario goes back to break even, and I made some money. Not a lot of money, but I made some money. Net worth's up a little bit. Of course, the worst case scenario we all know is that the thing gaps below our stop. There's nothing we can do about that. So let's put that aside. But assuming normal reaction, okay? So you bought a stock in the morning on a great day trade. It pops 3-4%, whatever. I might take off 25% and carry 75% of the position overnight. That way, if it comes back to break even, worst case scenario, I made a little bit of money. And if it keeps running, I'm not greedy. I'm making money on 75% of the position size. What I like to do is take bigger positions. In fact, this ARMR algo I'm working on, this S&P algo for swing trading the S&P. I know this might blow your mind, okay? But this is literally what I'm thinking because the statistics play out dramatically in my favor. If I'm using, let's say, the double the S&P, if I put 100% of my trading portfolio, let's just say, in SSO, for instance, and I get a risk on entry point, and I know that this works 80% of the time, and I get a 4% move on average to the upside and a 1.2% loss to the downside. Okay. If those numbers continue to play out, I can make money like that all day long. So what I want to do is have on 200% exposure at entry. This is just one example what I might do. So in other words, I'm going to have 100% of my capital to work in the S&P, which gives me 200% exposure. The first day it pops, right? There's an average return on all these positions. They all go up a certain percentage. It looks like somewhere around 1.5%, right? They pop, even the ones that fail, they pop and then they fail, right? So let it pop the 1.5% as an example in my illustration, right? And book half the gains. So now I just have 100% exposure to the S&P, and I took gain on that first pop. And then I manage the position the rest of the way. If this is a ripper that runs for the next 9 days, on average, they run for 9 days. Great. I'm going to capture 100% of the upside, right? So put on a huge position at entry, pop, cut it back, boom, trade it the rest of the way. That's what I'm thinking of doing. And that's crazy aggressive. I'm just giving you an example. I'm not suggesting you do that. I'm just giving you an example. Okay. Next, is there more to that question, Cheryl?
No, that covers it. Noel, you're up next. Would you like to chat with Bret about your BTC comment? We talk a lot about Bitcoin on the desk, on the ARMR Live Trading desk. Noel, you can unmute yourself. I think you know how to do that, or I can do it.
No, it was just a comment about Monday, I guess, right? Could go either way. And the fact that BTC is already back up above 20 this morning.
Yeah. I see that, Noel. And we use Bitcoin as a lead indicator on our desk. I know, Noel, you know that because you're on the desk with us. So certainly from a day trading point of view, it really works well. I mean, it's pretty interesting. I look at BITO and I look at that as a lead indicator. But yeah, I don't know what to make of that weekend action in Bitcoin. No, who knows? Who knows where it ends up Sunday night, Monday morning. I'm still a believer. I don't want anyone to get upset about this, but I think Bitcoin's going below 10,000. That's, there I said it. I still think that's happening until proven otherwise. Of course, if Michael Saylor can raise $500 million, issuing stock in a company that, I don't know why anybody would buy, so he can buy more Bitcoin. Maybe I'm wrong. Maybe they can manipulate and somehow support 20,000 on Bitcoin. I don't know, but I will share this one thought. I see Bitcoin comments on Twitter all the time, and they get all excited. Oh, there's a new ETF trading futures or whatever on Bitcoin. Let me just be very clear. Futures, options, and ETFs on Bitcoin are a negative for Bitcoin, not a positive. I know that you're getting a lot of commentators on Twitter saying the US government is going to regulate Bitcoin, and that's a positive. Who are they kidding? Okay, that is a negative. What skyrocketed Bitcoin is that there were no futures, no options, no ETFs, no regulation, decentralized. And this is what skyrocketed Bitcoin. And if you realize what's crushed Bitcoin from the 60,000s that it was down to 20,000 is futures and options and ETFs and regulation. Like, that's the last thing you want. So I don't know what the future holds for Bitcoin. Does it just stay in a trading range? I don't know. I don't know. But anybody's trying to sell you the snake oil that government intervention and regulation of Bitcoin's a good thing, please make sure you walk the other way. That's all my thought is on Bitcoin. Next question.
Awesome. Okay. So for all of you who are on Zoom with us, if you have
I'm sorry, Misha, let me just cut in. You know how I know that? Because I'm a precious metals investor and I've dealt with that manipulation for decades. Okay. It's not a good thing that GLD and SLV started trading. These aren't good things for gold. Just massive paper shorts against the actual. So, we've already seen this play out. It's just a way to manipulate price. Sorry, go ahead, Misha.
No apologies necessary. All right. So for all of you on Zoom with us, if you have more questions, now's the time to raise your hand or put them in the chat. I'm going to pop over to YouTube for a lightning round, Bret. We have a couple of questions there, and then we're going to wrap all of this up and everybody's going to go enjoy their weekend. So let me just pull up some questions from YouTube. You ready, Bret?
Yeah, do it.
Okay. Lightning round. Here we go. This is from Michael Sachs. He asks, what do you think of NIO?
Let's go share the screen, shall we? All right. Neo. Let me look at something else real quick. Geez, look at that breakdown of range resources. That's just terrible. Oh, well, massive volume breakdown in natural gas stocks. Not what I wanted to see. All right. NIO. So I'm looking at a William O'Neill Market Smith chart. Just wanted to take a peek at it. This is what I think of NIO. I'd rather own that chart. I'd rather own Tesla. I really would. Tesla is at the very top of my wish list. There's a list I'm making in the midst of a bear market. And I hope the bear market gets even worse and it drives my favorite names right down into basis for me. I want to own lithium stocks. Okay. They're like the bane of my existence. I've missed them all the way up and I really want to own them. I hope I get Livent back down near the 200-day moving average. Relative strength of a 97. Now, look, you can't hide behind relative strengths in this market because they're crushing great relative strength stocks. So it's not that relative strength is going to help you. It's just relative strength does show you where the institutions are hiding capital, okay, and collecting. So Albemarle, right? Livent, 96, 97. Tesla, I find Tesla absolutely shocking that the relative strength is already broken out to a new high in here. Do you see that, guys? 94 relative strength, and it's taken out the high relative strength right back here. So if you follow the William O'Neill style of investing and philosophy, relative strength leads price. I'm going to get to NIO in a minute, but if you look at Tesla, the relative strength has already broken out to a new high. That would suggest that Tesla is going to trade above $314.64 in the very near future. Now, if the market crashes next week, that won't happen. But if we get a risk on green signal, I think Tesla will probably be leading the pack. Okay. Now let's go look at NIO. 27 relative strength, 27 going nowhere. Relative strength not making a new high. And I'll just wrap up on this thought. How do I invest in Chinese companies? How do you invest in China? I don't get it. I can't trust the accounting. Okay. I can't trust the accounting. They lock down entire provinces whenever they feel like it. I mean, how do I invest in these companies? I'd rather just buy US companies. I'd rather buy European companies, Australian companies, Canadian companies. These are the areas of the world I like to invest in. No offense to anybody else out there, but that's where I like to put my capital. And if I like NIO and Tesla, then I really, really have to like the lithium stocks. And so that's what I'm hoping comes down and the market sell off. Next question, Shel.
Okay, next question is from Deb. Hey, Deb, Tech Monkey. She says, I'm taking a small risk on DKNG and selling before midterm elections. Thoughts on DKNG?
Oh, well, I'm not sure what midterm elections have to do with DraftKings, but it's funny you brought it up. I was looking at DraftKings recently because I'm building a list, Deb, of my favorite innovative stocks. Pinterest, Roblox, even though the stock Roblox was down this week. Snow, Tesla is at the top of the list. I'm looking for companies, what makes them ARMR power plays, I call them. These are innovative power plays. They have a dominant market position. Their sales cycle is getting tighter in the midst of a recession, which means even though there's a recession, customers are desperate for their product. So when I listen to conference calls with ARMR insiders all week, we listen for these types of things on earnings announcement conference calls. We look for sales cycles contracting, which means faster time to sales. Days sales outstanding coming down, getting paid faster. Customers are desperate for product. We're looking for a moat around the business. So I ask you, and I'm asking myself, where is that for DraftKings? I don't see it. Fundamentally, it doesn't make an ARMR power play list for me. And is the stock just going up because it always pops up a little bit when the football season starts? I don't know, but I bet there's some seasonality there. Every time football season starts, DraftKings pops up a little bit. But I don't mind the chart pattern. It looks like it's building a base. I just don't see the fundamentals there that there's just so many stocks I can own in a portfolio, Deb, and this one just doesn't make the cut for me. Next question.
Okay, we're going to land this plane and wrap up the forum with this one last comment from Mo. Actually, it's a good one on YouTube. I know you're going to appreciate this, and all ARMR insiders, I think this will be familiar to you because we talk about this. But Mo, this is a great comment. So Bret, here it is. My best market indicator is the herd on Twitter, FinTwit, and most stock friends. Go against them and you will win most of the time. Thoughts on that, Bret, as we make this our final question and answer on the ARMR Education Forum today?
Yeah, you're a contrarian, Mo, and I don't disagree with that. I would only say it depends on the market you're in. The herd makes an absolute fortune in a risk-on market where the Fed's adding liquidity. And so if you go against that, you get run over in 2020, right? So what you're saying, and I guess I'd like to wrap up on this thought because it's part of my Saturday suppositions I'm putting together.
Bret, hang
So-
on. While you do that, why don't you just stop sharing the screen?
Oh,
so that we can
yeah, okay.
see you and you can make your point.
All right, great. Yeah. I just, lost my train of thought, but my Saturday suppositions are about, and this is particularly true as I'm writing this new algorithm for trading the S&P. It's so obvious when I look at what I was doing last night and even this morning before I came on to chat with you all. I just can't help it. Once I start working on an algo, I'll probably sign off here and go work on it because I gotta keep digging for gold, as it were. But what I recognize is you really have to adopt a strategy. This is the biggest problem for most people with strategies and investment philosophies. You have to stay dynamic. You can't be static. What strategy works, and this is unbelievably true when it comes to writing algorithms. A strategy that works in one 3 to 6 month segment could be terrible in the next 3 to 6 month segment. So how do you address that when you're coming up with an investment strategy? You really have to take into account the type of world you're living in, the market you're looking at. As an example, here's a big picture example, right? This is the obvious thing we all know, but it ties into what Mo just said. So if I'm running a particular strategy and the Fed's reducing liquidity and raising interest rates, then I want that strategy to reflect short-term swing trades. That's it. Because the market's not going to give me long-term investing opportunities right now. So it's almost like you want to turn on your strategy that really works in that environment, right? And in that environment, a contrarian thinking really, really works, Mo. So the market ripped for like 24 days right to the 200-day moving average, and everyone's talking about how a new bull market started. And at the ARMR Report, we're buying puts on the indexes, right? We're getting short and the market craters, okay? So the flip side is in 2020, we're getting risk on green and the Fed's adding liquidity everywhere. You want to ride that for all it's worth. That's a time to actually own stocks into earnings announcements, which I don't like to do. But you're getting paid. The reward to risk is there. So you put the money to work. It's a different strategy. If you get locked into one thought, one strategy, it's very hard to make money using a static analysis in a dynamic world. And I'll leave you with that thought to ruminate on.
All right. Well, that concludes. And Deb, I see your comment in YouTube. She says that DKNG Prop 26 is on the November ballot. So I guess
Okay.
that's a connection with the midterm elections.
Oh, I appreciate that, Deb. Okay, thanks. It's kind of like investing in cannabis, right, Deb? For me, I'd rather, when it comes to November, my trade's in owning MSOS. That's my trade. And I don't own it right now because I obviously liquidated everything in my portfolio when the risk monitor went red. But I do own calls on MSOS that go out to next year, and they're like my lottery ticket. I'm not selling them. I'm either going to lose the money or I'm going to make a fortune. I'm willing to do that. And the first place I'll go for that election cycle is going to be cannabis stocks, in my opinion. That's just where I'm going. And I know you're there too. You're a fan of the cannabis couch. So let's sign off and go hop on the couch together, Deb.
All right. Well, I want to thank all of you for joining us here for the very first ARMR Education Forum. If you have ideas of how we can make this serve you better or questions to submit for our next one, please feel free to reach out to me at info@armorreport.com. We'll be doing this always the third weekend of every month. For those of you on YouTube, if you came late and didn't hear this invitation, if you join the ARMR email list, you will receive an invitation to be live on Zoom with Bret. You can talk to him directly. And for those of you who are on the email list, I will be sending around the link to the replay. If you wanted to listen back to answers to any question, or if you got here a little late and didn't hear the week in review in the beginning, you will have it at your disposal 24/7. So I want to thank all of you for spending time with us. Bret, thank you for sharing your wisdom. And until next month, everybody go really
Go
be
forth and
focused.
prosper.
Yeah, well, there's that too. But I was going to say, be really focused in how you can always focus on protecting capital and capturing upside in that order, because that is the core of the ARMR Investing Way. And that is what we're always wanting to share with you. So have a great weekend, everyone, and we'll see you next month. And next week, we will resume our usual week in review at 11:30 a.m. Eastern on Saturday. So we'll see you then.
Take care, everybody.